Chapter 4. Cost-Volume-Profit Relationships. Cost-Volume-Profit, CVP, analysis helps managers understand the interrelationships among cost, volume, and profit by focusing their attention on the interactions among the prices of products, volume of activity, per unit variable costs, total fixed costs, and mix of products sold. It is a vital tool used in many business decisions such as deciding what products to manufacture or sell, what pricing policy to follow, what marketing strategy to employ, and what type of productive facilities to acquire. Learning objective number 4 is to prepare an income statement using the contribution format. This approach is used as an internal planning and decision-making tool. For example, this approach is useful for and discussed further in cost-volume-profit analysis. Chapter 4, Budgeting. Chapter 10, Segmented reporting of profit data. Chapter 13, Special decisions such as pricing and make or buy analysis. Chapter 14. The contribution approach separates costs into fixed and variable categories. Sales less variable costs equals contribution margin. The contribution margin less fixed costs equals net operating income. The contribution format allocates costs based on cost behavior. The contribution approach differs from the traditional approach illustrated in an earlier chapter. The traditional approach organizes costs in a functional format. Costs relating to production, administration, and sales are grouped together without regard to their cost behavior. The traditional approach is used primarily for external reporting purposes. Learning objective number 1 is to explain how changes in activity affect contribution margin and net operating income. The contribution income statement is helpful to managers in judging the impact on profits of changes in selling price, cost, or volume. For example, let's look at a hypothetical contribution income statement for Racing Bicycle Company, RBC. Notice the emphasis on cost behavior. Variable costs are separate from fixed costs. The contribution margin is defined as the amount remaining from sales revenue after variable expenses have been deducted. Contribution margin is used first to cover fixed expenses. Any remaining contribution margin contributes to net operating income. Sales, variable expenses, and contribution margin can also be expressed on a per-unit basis. For each additional unit Racing Bicycle Company sells, $200 more in contribution margin will help to cover fixed expenses and provide a profit. Each month, Racing Bicycle must generate at least $80,000 in total contribution margin to break even, which is the level of sales at which profit is zero. If Racing sells 400 units a month, it will be operating at the break-even point. Total sales will be 400 units times $500 each or $200,000, and total variable expenses will be 400 units times $300 each for $120,000. Contribution margin is exactly equal to total fixed expenses. Let's see what happens if Racing sells one more bike or a total of 401 bikes. You can see that the sale of one unit above the break-even point yields net operating income of $200, which is the contribution margin per unit sold. If we develop equations to calculate break-even and net income, we will not have to prepare an income statement to determine what net income will be at any level of sales. For example, we know that if Racing Bicycle sells 430 units, net operating income will be $6,000. The company will sell 30 units above the break-even unit sales, and the contribution margin is $200 per unit, or $6,000. Part 1, the contribution format income statement can be expressed as profit is equal to sales less variable expenses, contribution margin, less fixed costs. Let's use the equation to calculate profit assuming Racing Bicycle sells 401 units at $500 each. The company has variable expenses of $300 per unit sold and total fixed expenses of $80,000. Part 2 sales is equal to $200,500. That is, 401 units sold at $500 per unit. Part 2 variable expenses is $120,300. 401 units sold at $300 per unit. Part 4 with fixed expenses of $80,000. We can see that profit or net operating income is equal to $200. Exactly the same answer we got using the contribution income statement approach. Part 1, we begin by calculating sales. Part 2, sales are equal to $200,500. That is, 401 units sold at $500 per unit. Part 3, variable expenses are $120,300. 401 units sold at $300 per unit. Part 4, with fixed expenses of $80,000, we can see that profit or net operating income is equal to $200. Exactly the same answer we got using the contribution income statement approach. Part 1, if the company sells a single product, like Racing Bicycle Company, we can express the sales and variable expenses as shown in the blue and brown boxes. Sales are equal to the quantity sold, Q, times the selling price per unit sold, P, and variable expenses are equal to the quantity sold, Q, times the variable expenses per unit, V. Part 2, for the single product company, we can refine the equation as shown on the screen. We can complete the calculations shown in the previous slides using the contribution income statement approach using this equation. Let's see how we do this. Part 1, we begin by gathering the information for the variables in the equation. Part 2, we have now entered all the known amounts into the equation and solved for the unknown profit. Part 3, as you can see, our net operating income or profit is once again determined to be $200. Part 1, unit contribution margin is equal to the unit selling price less the unit variable expenses. Using the equations we have developed, we can express the unit CM as P less V. Part 2 now, let's rearrange the basic profit equation for a single product company, and we can see that profit is equal to the unit CM times the quantity sold less the fixed expenses. Let's use this new profit equation to calculate net operating income when Racing Bicycle sells 401 units. Part 1, unit contribution margin is equal to the unit selling price less the unit variable expenses. Using the equations we have developed, we can express the unit CM as P less V. Part 2 now, let's rearrange the basic profit equation for a single product company, and we can see that profit is equal to the unit CM times the quantity sold less the fixed expenses. Let's use this new profit equation to calculate net operating income when Racing Bicycle sells 401 units.